Hello, I'm Regina McCann-Hess, President of Forge Wealth Management, and welcome to our Women in Wealth series. Today, we're going to talk about 9 investment pitfalls. Great timing on this conversation with the market being a little volatile. It's always good to refresh your memory on what are the important things that you need to think about. And experience has definitely taught us that successful investing requires discipline and patience. When emotions run high, it can be easy to lose focus on your investment strategy. So to help you overcome these challenges, we've compiled a list of common mistakes and guidelines. Now, it is important to remember that investing involves risks and that investment decisions should be based on your goals, your time horizon, and your tolerance for risk. The return and principal value of investments will fluctuate as market conditions change, and we are definitely experiencing that right now. Now, also, when sold, investments may be worth more or less than their original cost. So, just so you know, the market goes up, the market goes down. That's the beast, right? It's the beast of the market. It is volatile. So let's talk about the mistakes. So let's talk about the mistakes or investment pitfalls. Mistake number 1 is believing investing is a smooth ride. Investors need to remember that markets can be turbulent. And it's pretty easy to remember that right now because we've had a pretty turbulent market for 2022. But also remember back in February 12th of 2020 and March 23rd of 2020, the beginning of the pandemic, the Dow Jones Industrial Average lost 37% of its value due to the onset of the COVID-19 pandemic. Fortunately, recovery was swift, and by November of 2020, U.S. markets have returned to their pre-pandemic highs. Now, the markets don't always recover that quickly. So that's the other thing to keep in mind. It may take a lot longer than that for market downturns to correct. So preparing for declines is essential. There can be a strong temptation to pull out of the markets when they tumble. Instead of retreating, you may need to adjust your investment approach. By remaining flexible, you could be able to take advantage of opportunities while also managing your risks. The Dow Jones Industrial Average is an unmanaged index generally considered representative of large capitalization companies on the U.S. stock market. So when I'm talking about the index, S&P 500 index or the Dow Jones Industrial Average, just so you know, you can't invest directly in an index. You can buy an index fund, but you're not directly in the index. So it's important to point out that also past performance is no guarantee of future results. That is a common theme whenever we're talking about investments. Past performance is no guarantee of future results. I'm going to say that, that's the second time I said it, but it's important to remember. Mistake number 2 is trying to time the market. Now, when markets rally or pull back, seeking out the top to sell or the bottom to buy can be tempting. The problem, however, is that investors usually guess wrong, potentially missing out on the best market plays. For example, a recent BlackRock report showed that 100,000 investment in this S&P 500 composite index in 2000 would have grown to $324,019 by 2019. However, if an investor missed just 5 of the best trading days during that time, that investment would have only grown to $214,950.20. That's a big difference. So again, the S&P 500 composite index is an unmanaged index that is considered representative of the overall U.S. Stock market. And the individuals cannot invest directly in an index. Here too, it's important to explain that past performance is no guarantee of future results. Wow, we keep saying that. So what's the bottom line? Accurately chasing the market's top and bottom is virtually impossible. A better approach may be making small adjustments to just help you stay on course. Mistake number 3, risk and asset allocation. Not timing the markets is one thing. Another mistake can be creating a portfolio that doesn't reflect your overall risk tolerance. So when building a portfolio, the objective is to take on the amount of risk that aligns with your goals and your time horizon. Ask yourself the following questions. Do you feel like you're too heavily invested in one asset? Do you not understand why you own certain investments? Do you hold many of the same investments in different accounts? It's important to remember that asset allocation is an approach to help manage investment risk. And of course, it does not offer guarantee against investment loss. Mistake number 4, taking too little risk. A variety of factors may cause investors to act cautiously, including ongoing global uncertainties and fear about the overall economy. This can lead to investors flocking to low-risk investments, but those investments may not align with your overall goal. While minimal risk can feel like a safe move, you could miss out on opportunities. To know whether you should consider taking on more risk, you may want to start by asking yourself these questions. Do I have enough growth-oriented investments in my portfolio? Can I accept short-term losses for potential long-term gains? How comfortable do I feel taking on more risk to pursue higher investment returns? Mistake number 5, making emotional investment decisions. When markets swing, emotional decision-making can wreak havoc on the most carefully designed investment strategies. Fear and greed can drive anyone's financial decisions. Fear can cause us to abandon an investment strategy when the outcome is not what we want, while greed can cause us to chase investment fads and take on too much risk. So as you invest, you can support your strategy by attempting to manage these emotion-based decisions. As financial advisors, we may be able to help you when emotions enter the decision-making process. I have to say that the emotional decisions are big conversations that we have when we're experiencing market turmoil. These are big conversations that we have with our clients. So that when markets decline, remember that we can help answer your questions, provide reassurance, and show you the opportunities that volatile markets may provide. Mistake number 6, failing to diversify. It's been said that early merchants developed an innovative way to manage the risk. They divided their shipments among several different vessels. That way, if one ship sank or was attacked, the rest stood a good chance of getting through, and the majority of the shipment could be saved. So your investment portfolio may benefit from that same logic. Diversification is an investment principle designed to manage risk. However, diversification offers no guarantee against loss. The key to diversification is to identify investments that may perform differently under various market conditions. On one level, a portfolio should be diversified between asset classes such as stocks, bonds, cash alternatives. On another level, a diversified portfolio also should be diversified within asset classes, such as a diverse basket of stocks. For example, let's say a stock portfolio included a computer company, a software developer, and an internet service provider. Although the portfolio has spread its risk among 3 companies, it may still not be properly diversified as all 3 firms are connected to the technology industry. A portfolio that includes a computer company, a drug manufacturer, and an oil service firm, by contrast, may be considered more diversified. Mistake or pitfall number 7. Focusing more on returns than managing risk. Many investors chase performance, but buying an investment due to its past performance may not be a reliable way to find future winners. Investments that outperformed last year may or may not enjoy the same success this year. In short, if a particular asset class continually outperforms the broader market for 3 or 4 years, you can know one thing with certainty. You should have invested in that 3 or 4 years ago. Often, by the time some investors just decide to invest, their experienced counterparts have already moved on. Meanwhile, the not so savvy money continues to pour in past the investment's prime. Don't make this mistake. Stick to your strategy and focus on your goals, time horizon, and risk tolerance. Mistake number 8, ignoring the impact of taxes. So when reviewing investments, one factor to consider is the after-tax return of an investment. At first glance, a 5% return beats a 3% return any day of the week, right? Pretty easy math to figure that out. However, if those returns have different tax treatments, then the situation might change. So you might want to consider the impact of taxes whenever you buy or sell investments, develop a financial strategy, or discuss your estate and philanthropic approaches. Mistake and pitfall number 9, avoiding professional advice. 1/3 of all retirees and workers work with a financial professional, and 4 in 10 workers who don't currently work with a financial professional intend to do so in the future. Professional guidance can help, which is why financial professionals are one of the most common sources of information when it comes to preparing for retirement. Successful investing requires the ability to position your portfolio to reflect your time horizon, goals, and risk tolerance. This level of complexity can make working with an investment representative critical to your ability to pursue your goals. Now, investors who recognize and avoid these 9 common pitfalls may give themselves an advantage in pursuing their investment goals. An investment outlook requires a personalized strategy that accounts for your current and future needs, investment time horizon, and of course, that appetite for risk. These factors help ensure that no matter how the markets perform in the short term, your investments can be positioned to work toward your goals. Along the way, sticking to your strategies and not letting emotions get the best of you may be essential. With discipline and focus, you may be able to strategically turn your dreams into financial realities. Above all, financial advisors and investment representatives can apply their expertise to help you pursue your goals. I want to thank you for joining me today. And if you are looking for somebody to help you along your financial path, please feel free to visit my website at forgewealth.com. Again, I'm Regina McCann Hess, president of Forge Wealth Management. And you can follow me on Facebook, Twitter, and YouTube at Forge Wealth, and on LinkedIn as Regina McCann Hess. All right, have a great day.